We've got Joseph writing, oh man, I'm not even gonna try to pronounce that. Kondratieff's fifth wave technologies that triumph over centralized control and I don't know, there's a lot of letters on that one.
Okay, yeah, great. We'll go to the next. Okay, a little bit of an introduction because probably a lot of people don't know who I am. Started the investment business in 1989. At the same year, 1989, if you see this, I bought real estate at the top. Wasn't aware of it. That was the first bubble. And it was a great lesson because it just showed me market timing is really important when it comes to allocating assets. And you can see there was an elongated bear market. And what's interesting, that was global and prices fell 25%. The interesting thing about that is, if you maybe are old enough to know, is Olympia, York was the big fallout from all this. I mean, it was a big empire, real estate company completely collapsed. So it was an education, and that was really my start in the investment business. Next slide. That's me early in my career. So the obvious thing was, okay, I'm an investment advisor. What am I going to recommend? And my common sense said, who's the best in the world? And at the time, if you don't know who he is, that's John Templeton. He started his business in the 40s and became a multi-billionaire. Actually started the Templeton Fund in here in Montreal in 1954. Had one of the longest track records. And when I started the investment business, I didn't know what to do. And he saw that I was asking a lot of questions. And long story short, said, "Why don't you stay after?" And he explained his philosophy. Now, I'm being ignorant. I followed it, and then I got accused of market timing because I was making money for clients by selling what was hot and buying what was cheap. That was just my foray. So the first 10 years, next slide, was really involved into value investing. And Warren Buffett does a derivative of that. Later on, because I'm just curious by nature, I discovered and read this book, The Long Ways in Economic Life, and it was about a Russian communist economist who noticed in this capitalist system that it had these waves. And at the time he was working for Stalin, said to him, basically, the capitalist system is going to collapse, going to have a Great Depression, which he was ecstatic about. But then later, he said it's going to come back even larger than ever. And he was correct. For that, he was sent to jail with his gulags, and he later was shot and killed by this discovery of this evolutionary economic system, which is fascinating. Next slide. This is my own update from last year. These are these Kondratieff cycles. You can see we're still in the fourth wave. Now, Kondratieff, this is when capitalism started, if you see it in 1790, and each wave is driven by some type of innovation that changes the world completely. The first one was really the canal mania. The second was railroads. The third one there you can see was a combination of electrification and the railroads. That was in Canada because it was a little bit different. And the fourth wave was really driven by cheap oil, automobiles, and other mass production. Those were the keys of the fourth wave. And you can see this is being elongated and by this credit economy. A lot of people, I'm going to differ with a lot of people, is that we don't have a fiat economy, we have a credit economy. That is much more important to understand. We're not Argentina, where they can print and devalue the currency. We're a credit-based economy, which prevents the ability of hyperinflation happening. That's another controversy that I will talk about in the future. But capitalism morphed in 71 to creditism, where we went on this borrowing binge, and most of it went into real estate. One other thing I want to point out very quickly is I realized later that the Kondratieff cycle is a social cycle, and there's 4 seasons to that cycle: spring, summer, autumn, and fall, and then winter. We're still in the fall phase. We're about to, I believe, within a year, fall into economic winter, which is a depression, and I'll show you why. Next slide. Okay, this is a technological revolutions. You can see the time frames. This is by Carleta Perez, and you can see this is halfway, the 1971. This is the age of information technologies that we're seeing now. And the big one that we all know is the internet. By the way, this internet revolution is still growing. We're still having 1 million people join every single day. That's significant, and that changes. It laid the groundwork for, of course, Bitcoin and decentralized technologies, computer technologies, and of course this wonderful thing called a smartphone. So we're still halfway through it. A lot of us long waves are looking at what is the next long wave, what is going to emerge, and decentralization is a big part of it, and Bitcoin is that. So I'm not here just to talk about Bitcoin. Bitcoin is a monetary system that is evolving, and I'll explain why. Next slide, please. This is Carletta's prayers. This is a lot. I don't like to normally post things that people have to read, but we all know the central agenda wants a communist dictatorship at the top, and the WF and the UN and so forth to dictate it. This is where the area of my expertise, long wave theorists, neo-Marxists and neo-Chantoperians. Joseph Schumpeter was the one that actually called this the economic long wave, the most important tool in economic forecasting. And I just decided what to do differently is to put them all together. And including another person who actually has a model in the US who does spectacular managing capital for clients. And I said, why not bring one to Canada? And I launched it last year. So if you read long wave theories, you will get different interpretations. Some focus, like Carletta, on the technology, some on allocation. That's also what I do. Some are focusing on the social mood, because social mood changes in each part of the season. And that's why you're starting to see, like for example, let me look at the mortgage market. When it first was introduced, right, this is a recent innovation, less than 100 years old. Most people who took on mortgages, they had mortgage burning parties. They're more interested in getting out of debt because of the trauma of the depression was a credit collapse. Well, the same thing will happen. This overconfidence in leverage and buying real estate is going to end, and it's going to end very poorly. That will probably start in the second wave going down. Next slide. Okay, this is a great one for Bitcoiners. Notice that we have these different price waves, and if you are interested in history, there's a great book called The Great Wave. It's about 20 years old, and you can see that this fourth price wave of inflation is coming to an end. This is where we agree, long wave theorists and Bitcoin crowd, and realize that these different inflation periods, and notice for 100 years, they stay stable. So what does that sound monetary system that is about to emerge look like? It's going to be a stable environment where you do have economic growth. And notice when the Renaissance occurred, during a time of stable prices. So even during other periods. So this is really important, and I don't see it in slides, and people read that book. It's heavy, but it helps you understand that we're coming to the end of another price revolution, and that simply comes from fiat. Next slide. This is also coming to an end. I would argue that the greatest bubble in the world after governments is real estate. And if you look at the Amsterdam Real Housing Price Index, you can see it's pretty, notice that it's cyclical, right? And this makes sense to anybody who studies cycles and business cycles, right? But notice that it just went off the chart. And this is global, by the way, where everybody's pretty much gone into real estate. What's terrifying of this is that we've leveraged from the zero bound, which has never happened in history. In 2020 or 21, if you would have told me we would have had one more leg of credit borrowing for real estate, I wouldn't have believed you. So now the central banks will be pushing on the string, because you need interest rates to be lower than where the leverage took place to soften the blow. When I went through the collapse in real estate, the collapse in rates in the early 90s helped me stay solvent. I couldn't go bankrupt because I was working in the investment business, so I had to pay back all that debt because my condo at the time fell below the leverage area. And one of the things people are not aware of, if you have that capital loss, you're on the hook for it. A lot of people aren't aware. Next slide. You can see this is global, this is the median real house prices around the world. And so what happened here? We had stable prices, then we had the monetary systems change, and then from the early 80s, we call this the monetary wave, where the price of credit falls, which causes Ponzi finance. If you ever study technologies, how to look for a growing industry is where the marginal cost is falling, which increases adoption rate. So the smartphone, the internet, computer, laptops, those are great technologies, right? They got cheaper and better every single year. Well, one of the things that's very unique to the long wave is that we call this the monetary wave, where the economy shifts and it becomes financialized, and where the utility benefit of the banks shifts from helping society to helping itself because they are financing Ponzi finance, and the biggest around the world is real estate. You know, how could prices go so high when incomes are stagnant? And the reason for that is that people were able to leverage, and I recall, I was young, very young at the time, but real estate changed in '84 because when interest rates peaked in '81, all of a sudden a person said, hey, I can get a $300,000 home instead of a $200,000 home because people look at their cash flow. They don't look at the amount of debt they're taking on. So that's why you've had this leverage. They're just looking, okay, I can afford $2,000 a month instead of $3,000, so why not take more? Now the opposite is happening, right? We're getting the opposite effect, and that's why real estate prices have been correcting. Next slide. This is a great chart, and I put in here the monetary way, but notice this is real home prices. You notice here, for almost 50 years, real home prices were stagnant, and that was during the greatest population growth in Canada's history, even though people think that we have an immigration boom, but we have this massive Ponzi bubble that started right at the bottom of 1982. So, and that's going to correct. If you understand cycles, we just had I call it the climate change bubble collapse, where you see now solar, wind, anything tied to the ambitious goal of the UN collapse 50 to 90%. We have multiple bubbles, and these are the most dangerous because it impacts the economy. What's scary for people like myself is in 2015, the CD Howe Institute put out a report that the bubble was bad then, and we went on to double from there. And if anybody would have said we would have extended it until 2022, 2024, I would have believed it, but then I believed in 20. And I'll show you the data, why I'm convinced this great real estate market is over. Next slide. Oh yeah, this one of my clients forwarded this, and you can see even that mania is occurring in farmland and real estate. I mean, look at this cycle. Basically, there was an economic growth, yet prices stayed stable. We had that rise. That was the commodity cycle. That's what drove up prices. Then it collapsed. Look at real terms from 1995 to 1920. Went nowhere. This is what everybody wants to see. As your standard of living goes up and then wages go up, you could purchase farmland cheaper than your parents or your grandparents. But that ending there is simply from fiat. And everybody on the farm agrees with that. It's not because we're running out of land in Canada. This is a chart. I found it by accident in its archive, but this is what caused Canada to boom. And this is real wage growth adjusted for inflation from 1920 to 2020. Notice even during the Great Depression, real wages were increasing. Nominal wages were falling, but real wages, because everything was collapsing price. So this is what caused the great immigration boom. And here, look at this, from 1980 to 2020, 2024, real wages are stagnant. Real wages, right? Nominal wages, your wages have been going up. And so how can real estate prices, why are they any higher than they were in 1996? Why is a home in Toronto worth $1.2 million? It should only cost $250. Well, we're going to get there. Unfortunately, we want to be wrong about this, but we're going to get there because long-term wage, real estate, and inflation are what drives prices. when we get the banking involved, this is where all the trouble starts. I'm going to tell you one other thing. I started in 1989, and I was in the investment business for 23 years, and I left in 2012, and I retired because most of my clients at that point, after 23 years, are wealthy, and they're risk averse, and where do you normally put them? In bonds. And I did the math, and it was obvious that in the next 2 years, we're going to start getting defaults. I knew it back then, but I didn't believe that it would happen for 20 years. But COVID came, and then we have this liberal government, radical government that are destroying the concept of Keynesian, and now we're at the point, and I'm going to explain why those advocates, those maximalists who call yourselves a Bitcoin, you got to get your message out there, because the audience is coming. By the way, in 2000, I saw the bubble and lost some of my clients, and then my business tripled. I did the same thing in 2008, saw it come, got everybody out of the market, and I did really well. So I do well in downturns because we see bubbles. So I can spot a bubble, and I got that lesson from losing by buying at the top. So if you want to speak to an expert, they've had to lose money. If you want to know anything about money, you have to go through a bad experience, because you need to learn the lesson, what happened. Next slide. Okay, this is my chart. By the way, if you follow me on Twitter, I've updated it this morning, and I was hoping before it could start. But I hope you can understand this. If you look at, this is mortgage credit growth journey credit area. I don't call it the fiat area, credit. Notice the 1970s, we had the greatest year-over-year change in credit, mortgage credit growth, and that was in a rising interest rate environment. The reason why it didn't impact real estate, because real wages were increasing. So rising interest rates are always a sign of health. If anything, the long wave, which started in Canada in 1946, peaked in the 70s, we had a secular rise in interest rates. But real estate prices rose. Why? Because wages were keeping up with prices. But interest rates were rising, was keeping the speculators out of the market. There wasn't a benefit for speculators to leverage, right? And we didn't financialize the Canadian economy. When I started in the 89 and the early 90s, after the collapse, a lot of capital flow left real estate and GICs because they weren't double digit, and they went into mutual funds. And if you wanted to buy a mutual fund and you went to the bank, they said, well, that's risky, go to the small firms. I used to work for Investors Group, still a big firm today. That's where I got started. And they became part of it. So the whole banking system, investment and mutual fund business, is all new at the banks. They didn't exist prior to 89. And everybody's buying into this asset. So I just saw what was going to happen. And there's a lot of us who've worked 20, 30 years in the investments that left. We just see that the financial sector is going to collapse by 50%, if not more. Half of the people that are working in this field will not be in the business 10 years from now. But notice exponential growth, and notice that it's slowing. Look at this trend line here. Notice the secular slowing, the linear trend line. And this is saying by the 2030s we'll be in economic winter. That's a depression, a credit collapse, and a depression. We call it creative destruction, where the whole system collapses, and what's arising is a decentralized world. Maybe countries breaking apart. This is inevitable. Next slide. This is total household credit, and again, look at the exponential line to the left. So I just trend it, and you can see that it was slowing in 2017 before COVID, and every business cycle we see a slowing of credit growth. And look at the trend line to the 2030s. So it's easy to say by the 2030s we'll still be in economic winter. It hasn't started, right? It's 4 seasons: spring, summer, fall, and winter. We're still in fall. I think it's over. We just need the second leg in a credit contraction, and I think when I get December's numbers in February of next year, we'll actually have a credit contraction. That's the definition of economic winter, depression, when credit starts to contract. Governments, central banks, Keynesian economics believe that they can stop these cycles. And now they are going to fail. So everybody's worried about the UN and central bank digital currencies. I would say they're all going to fall. They're terrified. They know what's coming. And there's a revolution that's coming, a popular uprising, as Bob Hoy says, because they'll realize these inflated real estate prices were it's just phantom wealth. I mean, I looked at the numbers in Montreal, 50% rise since 2020.
Yeah.
That's mathematically impossible. How is that possible if incomes are stagnant? It's all credit growth. And when that unwinds, then we'll be exposed to the reality. It was just like a bodybuilder on steroid. Once the steroids are gone, their body deflates by 20, 30, 40, 50%. And unfortunately, in the city I live in, Toronto, great city up until it was financialized, the model's projected a 75% collapse. I know, can't happen, they won't allow it to happen, and if it happens, whatever. But look at every bubble. I've got every bubble in history. Look at the climate change bubble just burst. We got an AI one that's going on. Look at 3D printing, 90% down these stocks, right? If this is built on credit, why won't this collapse? Look, we're not getting the exponential growth. Now, I want you to take away one thing. Most forecasters fail because they don't understand the four principles of how the economy works and why we make mistakes. And it was my epiphany 10 years ago. All of a sudden, my forecasting went through the roof. And it was that I realized, I was reading a book on evolution and realized we're hardwired to think linear. So we only extrapolate the current trend and think that will continue. The real estate will always go up. Stocks will always go up. This party will always go up, right? So we're hardwired. We don't see cycles. But if you understand energy moves through a cycle, that's why there's business cycle, the Kuznets cycle, which is real estate, and then the long wave cycle. And you realize, well, this is a social cycle. It's reflective of human nature. And innovation occurs through these cycles, but some occur more in other times. So if you think that we think linear, the economy grows cyclically, debt grows exponentially, and technology grows logarithmically, right? When you understand them all and you put them together, you can make an easy forecast about what's coming. That's why I'm warning people in the Bitcoin crowd, get ready. The audience is coming towards you in the next 1 or 2 years. Next slide. This is the cycle. This is Ray Dalio's work. His books are fantastic. And this is when it started. I wrote the date. This is the financial cycle. And I'm looking at, I forecasted we're going to peak between 2022 and 2025. I'll show you why. And that's the deleverage and the reflation, and then Kondratieff's fifth wave. Normally, there's a 3-year collapse and an 18-year workout period. It makes sense. Why is that? Because the new generation that grows up doesn't know about the concerns of debt, whatever. They just hear the story from their parents, right? It's a psychological change. Why do my mother is still alive? She still is fearful of debt growing up during the Great Depression, where the current generation, well, what's a $1 million mortgage as long as I can carry it? They don't understand the risks. Okay, this is one of my favorite charts. They're excellent books, The Economic Disaster, A Brief History of Doom by Richard Vague and BIS. This is when credit bubbles peaked and before there was a credit contraction. In 1929, we know about that story. It was 154%. Japan, in its bubble, I remember this because I started in the business then, and Japan was going to take over the world. They were, they're producing everything. They're running twin surpluses, unlike Canada. Leaders in technology, great savers, hard workers, but they had a private credit bubble, and they're still trying to dig themselves out of that. Look at Canada in 2020. We surpassed that. And it's a warning, it's not a timing. Peter Kondo was one of my mentors. He said valuation is a measure of risk, not timing. We don't know when it's going to collapse, right? So I do the same thing with private debt. It's a measurement of risk. So Richard Vague says anything above 150% and there's an acceleration of debt, that's a warning. And you can see the bubble here, it started in 2000. and there was the blow off in 2020 and 21. So it's now when that trend rolls over, I believe we're close to economic winter. Next chart, please. This is a chart I made, and I said, I wonder if it's similar. Because if you understand social cycles, look at the similarity here. I mean, this is absolutely amazing. See how it's very similar? And I put the dates, 1990 to 2020 in Japan, 64. And look at the similarities, and then you see the blow off there for Canada, which is unprecedented in terms of private credit bubbles, and again, from the zero bound. And we're running twin deficits. So, this twin deficits is leading to the next issue regarding Bitcoin decentralization. Next chart. There's, I think everybody's seen the chart, a history of time. There's 5,000 years of interest rates, and we just leverage from the zero bound. So there's no reference to compare, because as an historian, I'm trying to understand when is this thing going, what do we do from here? So that means the central banks now are impotent. They have no influence in the future. They are slave now to government's fiscal spendthrift ways of the future. Next slide. This I made because since I'm interested in long waves, this is probably the only chart that you've seen that actually uses the data of 29, which was a historical time when most people buy their first home. And you can see here during the long depression from 1873 to 1896, there was still a growing population. So this population growth story is all bunk if you actually look back far enough. Even during the 1930s, look at the population, that age growth. Now, do you know why you get the peak in 1960 during the Great Depression? Fertility rates collapsed and it bottomed in 1936, so that caused that cycle. The peak in 91 is the baby boomers. The peak in 2022, when it actually did peak, is the millennial generation, right? And then you can see we're going sideways. The other one is what happened to Japan, because Harry Dent, who studied demographics, said, why didn't Japan's real estate come back? And it was the exponential growth in deaths. The baby boomers, one of them, is the largest cohort of Canadians, and they're going to be putting a lot of supply on the market. And look at this period here, 2024. It's accelerating beyond the exponential trend line. Next slide. This one is the Kuznets cycle, which is specifically just ages 30 to 34. Most of the time, I know that's mathematically impossible today when they buy real estate. So if you can see, there's a baby boom, there's a millennial boom, and the millennial boom peaks this year. You can go on any demographic chart and see. Now, I know we have these immigrants, but they don't have the money or savings. I use the people that actually, that's why I use the 2019 data before the immigration boom, because I know they have the money, they live here. So a 30-year-old Canadian who's born and raised here compared to a 30-year-old immigrant, their financial situation is going to be dramatically different. Their savings, their knowledge of the economy and so forth. So this is where it ends, and you can see that it doesn't bottom until 2032, and that's why I believe that we're going to have a very long real estate bear market. A very long. Just the demographics is poor. And if you, those who believe in immigration, one other story to understand is immigration plummeted during the previous two Great Depressions. Obviously, if you got 10%, 15% unemployment, the public is going to rise against the political elite and say, hey, stop it like we did in the 30s, and once we get our act together, we can open up the immigration spigot. So we did that after 1945. Next slide. So here's the latest update, Canadian real home prices. You can see pretty much we had these cycles. This actually was a deleveraging, and that was this is the start of the financial cycle. And just draw a trend. There was a peak in 89. You can see for a decade in the 90s. Now, I was an advisor. We didn't have real estate as competition because all the rent seekers were wiped out, and nobody was interested. So we had a mutual fund mania. So at the time, people were saying, hey, why invest in mutual funds? Invest in the mutual fund companies, and they were doing much better. But of course, like any mania, it came to an end. So we've had multiple. One thing to notice, see the trend line out of 2000, we finally broken that trend, and that will correct
50%, that's the forecast. They're on the model, right? Everything. Now, what does 50% do? Impacts the banking system, which is what causes credit contractions. And I had this discussion with my friend here, Stephanie. We were talking about why it's a social cycle. I hear this, and I'd love to get into a discussion about this, is that they think they're going to print out of this. That's assuming that the public will want to borrow. When you get a credit contraction, nobody's interested in borrowing money or lending money. We all turn fearful, and it feeds on itself. It's a social thing that actually drives the market. So in the mania, everybody gets caught up. Hey, you know what? It only goes up. So when the credit contraction starts on the second wave, if you know anything about Elliott waves, the psychology takes over. Then the banks become fearful. They tighten up credit lending. Then the borrowers, and I know that, I watched it collapse and said, I'm not going to touch anything. And all the people who want to purchase real estate just stepped away. You can print all you want, but the printing, they might even deposit in your bank account, but people say, you know, we got a depression going on, I'm just going to pay down my debt. So I don't think you can print your way out of a credit collapse, because you need a willing borrower and a lender. And when the psychology changes, is what happened in Japan, nobody was interested in lending and borrowing into real estate. And hence they had this extended bear market. Next slide. This is where I live, and you can see how ridiculous. Here's home prices, income to income, and inflation adjusted. You can see that the bubble here in '89 was only 6.7, and at the peak in 2022 it was almost 18 times income. I mean, and now it's still 15.6. That's going to correct. 75%. Historically, before 76, it was 2 times income. And I didn't know this until I studied. The reason it doubled is women came into the workforce en masse, and they couldn't qualify for a mortgage. Did you know that? I didn't know that. So, I mean, you could be married, but you couldn't put your spouse or wife on the mortgage. So that's what started this, and real incomes are rising, but that's how prices went up to 4 times income. Then it corrected. There was a long bear market in our city, or my city, and then you can see it just accelerated. And that's a normal blow-off, like any mania at its peak. Next slide. Bitcoiners, I think you're going to love this. This is the value of the Canadian dollar since the inception of the Bank of Canada. And you can see how much the Canadian dollar has fallen by over 95%. $100 is now worth $4.75. And that's an exponential trend line since the inception. And these are just dates I put that are important when the Bank of Canada, the inception of the Bank of Canada, the breakdown of Bretton Woods, the Financial Renaissance, which is over after 40 years of falling interest rates. The Financial Renaissance is over. And the stagnant real incomes about 1985, where incomes in real terms become stagnant. So what Canadians have done is they've gone into debt. Remember this Kondratieff fourth wave, we never had credit cards in other waves. So the modern credit cards started in the 50s. We had long-term mortgages, but the psychology of the generation that grew up with it were risk averse. And they had these things called mortgage burning parties. You can Google it. It's fascinating history. Next slide. I love this because this is one chart that needs to get out there regarding the socialists, and I consider myself at one time a socialist. My parents were immigrants, factory workers, and I was concerned in the NDP or left of center were protecting the workers' right. But this theory came up from Marx, and he had this theory about how the economy works, and really we've seen the failings of socialism and Marx. But take a look at, this is the lifetime of Karl Marx, and take a look at to the right, the retail price index fell throughout his whole life. So this is what we're talking about, right? Deflation. But look at the wages, the average earnings of somebody who's living in the UK. Their standard of living was going up dramatically. And this was the first capitalist revolution, where prices fell and real wages rose. that's what brought the world into this capitalist economy. That's what we're trying to design, right? We're trying to design where price deflation in most things we purchase, but our wages are going up. Or we can have stagnant real wages,